Okay, welcome to the third part of the statement of cash flows video series. So basically this chapter we are recording in multiple sessions because I know this chapter is a bit heavy kind of a chapter for some of the folks, but it's okay. So that's why I have bifurcated the video into 4 parts, 3 to 4 parts we are going to record it in. Up till now we have seen that okay, what is a statement of cash flows, what are the 3 types of activities that are there in statement of cash flows, that is the operating, investing and financing, and what each activity stands for and what is there in it. And now let's start with net cash flow from operating activities. So net cash from operating activities, we have two methods. One is the direct method, one is the indirect method. Now the direct method, it shows actual cash received and paid from our operations, and it looks similar to an income statement but in cash terms. Okay, what is the difference between a direct method operating activity and a income statement is that the direct method of the income statement, the direct method of the operating activity, it is prepared in such a way where only all the cash related transactions are included. Anything which is accrual based, which is based on forecast, which is like any kind of provision, is not included over here because we are preparing statement of cash flows. Now, one is the direct method, next is the indirect method. So what happens in the indirect method? It starts with net income and adjusts it to arrive at cash from operations. So that's what indirect method is about. So direct method is how it looks, it's exactly like an income statement but in monetary terms, not monetary but in cash terms. Like it's like a cash basis of accounting, whereas a normal income statement, it follows accrual basis of accounting. When it comes to indirect method, the indirect method, how does it starts? We will have first of all net income, and in that we will do plus and minus all the adjustments. Now let's read this blue box. So both methods are allowed under US GAAP. Both give the same final answer. The difference is only in presentation. Company must use the same method consistently every year. So that's what is about the cash flows from operating activities. Whether you prepared it using a direct method or the indirect method, you're gonna get the same final answer. The difference is only how you present it in your statements. Okay. Now moving to the key understanding. Okay, so now about the direct method, it converts each income statement item into cash and it shows actual cash received and paid. And what's the formula? Revenue should be equivalent to the cash actually received and expenses is equivalent to the cash which is actually paid. For example, let's take an example. Suppose this year I need to pay the subscription of Netflix. Okay, this year I need to pay the subscription of Netflix by 31st December 2026. Now suppose I am like, I don't have enough funds, so I requested Netflix people that hey, can I pay it after say 10 days, can I pay it by 10th of January? My due date was for the expense was 31st December, but I actually paid it on 10th of January. So when on 31st December I am preparing my income statement, in that I am showing the Netflix subscription. I am showing the Netflix subscription as an expense. But did I actually paid it in cash? No, I didn't paid it in cash because I requested them for a extension. So in that scenario, what happens if we are preparing the income, our cash flow from operating activities, we need to exclude this Netflix subscription ka expense, whatever we have included over there in our income statement. Okay, I'll just clear this off. Fine. Now in the indirect method, it starts with net income, then adjust for non-cash items and working capital changes, and it is more commonly used in practice. So this is the more common one as compared to the direct method. And also in the examination, first of all, in nowhere you will be asked to prepare a full-fledged one, because again the exam is MCQ based, and also in the essay section you will have drop downs, you don't have to type anywhere. So most of the places, like in maximum number of places, wherever statement of cash flows is tested, it will be operating activity. If operating activity is there, then for sure it's gonna be indirect method. There is very less probability of getting direct method. Now, how does the direct method works? Let's understand. So for the direct method, it has three key adjustments. First, convert accrual numbers to cash, then remove non-cash items and remove non-operating items. What is there in these three key adjustments? Let's dive into this. So first of all, income statement numbers are based on accrual, so we adjust them. So that means revenue should be equal to the cash received and expenses should be equal to the cash paid. Then remove non-cash item. So some expenses do not involve cash. So like expenses like depreciation and amortizations, these are to be removed. Then remove non-operating items. So what are non-operating items? Example, gain on sale of asset, loss on sale. They are removed because their cash effect is shown in the investing section. Okay, now coming to the direct method, one solved example is there. Let's have a look at it. So how do we prepare cash flow from operating activity using direct method? Let's understand. So over here we have been given this information. 12 lakhs is the sale, beginnings accounts receivable, ending accounts receivable, and we need to find the cash received from customers. So cash received, how did we calculate? First of all, this year ka sale plus beginning accounts receivable, that means the accounts receivable, the amount which we have to receive from the customers at the beginning of the year. From that we are subtracting the ending accounts receivable, that means the amount of money we are supposed to get from our customers at the end of the year. When we put this formula all together, we get the cash received as 11,70,000. So basically this is the total sales. This is the beginning accounts receivable, that is at the beginning of the year. How much is the outstanding? So sales plus beginnings accounts receivable. Then at the end of the year, only those accounts receivable will be outstanding. Only those customers will be there over here who have not paid us the cash. So simple, beginning accounts receivable plus the sales which we have done throughout the year. From that we are removing all the accounts receivable that are outstanding. That means that are yet to be paid to us at the end of the year. So the remaining amount of money, that means we have already received it. So that's how we got the 11,70,000. Now beginning accounts receivable is added because it's already earned and it is collected this year. Ending accounts receivable is subtracted because this is earned but not yet collected. Now this is very important exam insight which I have already told, that the full preparation of using the direct method is not tested in detail in the CMA exam, but understanding the concept is important. It's important for us that we understand the concept irrespective of the fact whether it is asked in exam or not. Because say suppose tomorrow you appear for any of the interviews, you have a role of bank reconciliation, like something like that. Suppose in that if they ask you a question that what is the difference between direct method and indirect method, so it's not like we are just understanding these things just for passing the exam, because once you finish your CMA you move on to another job, you are looking for something else, then what happens? Then obviously there is a high probability that whatever you have studied, they might ask some questions from here and there. So it's good to have a good knowledge about these things. Okay, moving on to the indirect method. The indirect method of the cash from operating activities. Now what is indirect method? This method starts with net income and converts it into cash from operating activities. Think of it like profit is given, now convert it into actual cash. So basically we are going from accrual method of accounting to cash basis of accounting. Okay, this is the only method tested in detail in the CMA exam. You must know all the adjustments clearly. Okay, so first of all, this is very important from our CMA US exams POV. Let's understand how to prepare cash from operating activities using the indirect method. Okay, so how do we start? First of all, we have been given 6 steps. Step 1, start with net income. Step 2, adjust the non-cash items. That means add back the expenses, subtract the non-cash income. Wherever cash is not associated but it has been included on our income statement. Best example, depreciation. Another example will be impairment of goodwill. So these are what? These are some of the things some of the line items which we record on our income statement, but in reality what happens, they don't have any monetary impact, they don't have any cash coming in or going out of a business. So we need to adjust it. Then we need to remove non-operating items. Non-operating items means if any investing or financing activity has been included. One of the examples, gain on sale of machinery. Gain on sale of machinery, in that there is not an actual gain of cash which you are getting in, we are recording it on our books, that has to be removed. Then any other such financing activity which we have recorded, that we need to remove. Then adjust the working capital. Adjusting the working capital means CACL. What is CACL? Current assets and current liability. First of all, what is working capital? Working capital is current assets minus current liability. So what is working capital? The amount of money which we need on a day-to-day basis to run our business easily, smoothly, without any hassle. So that is what working capital is. And how do we calculate a working capital of a business? We take all the current assets and from that we remove all the current liabilities. Okay, then number 5, special items. What are some special items? Like trading securities, bond, discounts and premium. So these are what? These have to be removed. Now next and lastly, we get the cash from operating activities. Okay. Now 4 types of adjustments. First, remove non-cash items. Some items affect profit but do not involve cash. Rule: if expenses reduce net income, add back. This is a golden line. If expenses reduce net income, add back. If income increased net income, subtract. How do we understand this? Let's have a look at these 2 boxes. First of all, depreciation and amortization. These are expenses but no cash outflow. So that's why they are what? They have been added back. Then unrealized loss. Unrealized loss means what? It is not an actual loss, but we are conservative accountants. So what we do? We as a conservative accountants, we have a conservative bend of mind. So sometimes we already recognize a loss which is actually which has not actually occurred. So in that case, what happens? My net income is decreasing. So what I will do? I will add back any component which has a non-cash impact. Then what do we subtract? Unrealized gain, increase net income. So unrealized gain, if we have any kind of unrealized gain which we are recording it as a profit, but in reality we are not getting cash out of it. So in that case, what do? We subtract the unrealized gain. Then second, remove non-operating items. So what happens? Income statement include items that belong to investing or financing which has to be removed from the operating activity. So their actual cash effect is shown in the investing and financing section, because as of now we are preparing cash flow from operating activities using the indirect method. Now gain on sale of asset. Gain on sale of asset, what happens? Gain on sale of asset has to be subtracted. Then losses on sale of asset, it has to be added. So that's what, if there is any loss or any gain, we need to treat it accordingly. We have to see the impact of it on our profit. Losses are doing what? Loss is reducing my profit, so I will add it back. Gain is doing what? Gain is increasing my profit. So to bring my profit to the normal, I have to subtract it. My profit is this much, I have added a gain. My profit is this much, I have added a gain. My profit has gone up, right? So now I have to bring it to normal, so I have to reduce it. Similarly, my profit was this much, I added a loss, my profit reduced. This was my actual profit, so I need to add back the loss. Simple. Now third is the working capital adjustments, which is the most important. First of all, what was working capital? current asset minus current liability. Again, I am reiterating, current working capital means what? The amount of money a business needs to have to carry on their operations smoothly. So that is what current asset minus current liability gives us. That is the working capital. Achha, why do we take only current assets minus current liabilities? Why not non-current assets and non-current liabilities? Because we don't take this, because this is what? This is long term, this is short term, this can be easily liquidated, that's why. Okay, now operating assets move in opposite direction, operating liabilities move in same direction. What does that mean? Let's understand point by point, and I'm assuring you guys this will be very clear to you all. Okay, now operating AR increase, that means what happens? Your accounts receivable is going up. That means revenue booked, cash not received. That means you have recorded a sale in your income statement. Because of that, your profit has gone up, right? Your accounts receivable has increased, your profit has gone up, but in reality you have not received the cash. So what you're gonna do? You are going to bring it back to the normal. So you're gonna do what? Reduce the or subtract the increase in accounts receivable. Now second, accounts receivable decrease, this has to be added. Why? Because these are the last year ka money, this is the last year ka money which has been what? Which has been collected. So what is happening? The accounts receivable is decreasing, that means we are getting it back. So last year we have not recorded this cash, so what we have to do? We have to record it this year. So that's why accounts receivable should be increased. Now third, inventory increased, that means we have bought more than sold, that is bought more than sold, cash paid. So what happens? That means we have bought, the number of items we have bought is more than the number of items we have sold. So that's why there is a decrease in inventory. That's why we have to subtract that particular amount, the increase in inventory amount, in order to record what? In order to arrive at the correct figure of cash flow from operating activity. Okay, next comes the inventory decrease. If there is any decrease in inventory, that means we have sold the old stock and no new cash has been paid. We have sold the last year's stock and we have not paid any new cash. In that case, what we are gonna do? Decrease in inventory, we are gonna add back the amount in our cash flow from operating activities. Now one note, always use net AR. Net AR means what? As we know, in accounts receivable we have gross accounts receivable, and from that we reduce what? Allowance for doubtful debts. And now sometimes it is also termed as allowance for credit losses. Okay, so allowance for doubtful debts or allowance for credit losses, these are one and the same terminology, just in case you get the this terminology in exam, so don't get scared. So what we have to do? Whenever we are calculating, whenever we are doing this calculation, adjusting the accounts receivable increase or decrease, what we need to do? We need to do what? We need to take the net accounts receivable. Net means what? Gross accounts receivable. From that we need to subtract the allowance for doubtful debt or allowance for credit loss, and then we are gonna use that figure. Now coming to the operating liabilities, these move in the same direction. What does that mean? If accounts payable is increasing, what we are gonna do? We are gonna add it. Okay, and if accounts payable is decreasing, we are gonna do what? Subtract it. Same rule applies to salaries payable, rent payable, interest payable. So what is basically happening? If accounts payable is increasing, that means expenses recorded but cash is not paid. That means, like the Netflix example I gave, this is the same thing, that we have recorded it on our books of accounts on 31st December, but I actually paid it on 10th of January. So expense has been recorded but cash is not paid. So that's why what I'm gonna do? I'm gonna add it back. Okay, now coming to the AP decrease, we have to subtract it. Why? Because we have previously paid all these dues. So that's why it is being subtracted. So one thing to remember, in the case of assets, opposite direction. In the case of liabilities, same direction. What does that mean? Accounts receivable increase, that means we need to do what? We need to subtract. Now accounts receivable decrease, we need to do what? We need to add. Okay, that's what it is all about. Because see, this is increasing, this is subtracting, decreasing, adding, increasing, subtracting, decreasing, adding. So just to make this clear, I'll just mention it over here. For the assets, increase, decrease, decrease, increase. Then for the liabilities, same direction, increase, increase, decrease, decrease. Okay, see, it's given also over here. So it's very simple. Asset up, cash down, liability up, cash up. Basic one line memory trick. Okay, now bond discount and premium, which is termed as very testable over here. Let's understand what are they. So these are non-cash adjustments. These are non-cash adjustments affecting our income. These are non-cash adjustments affecting our income. So bond held as investment. So bond, when it is held as investment, it is what? Discount amortization. Just a second. Okay, sorry for the interruption, guys. Yeah, we'll get back. So we were discussing about the bond discount and premium. Okay, so first of all, what we were discussing about, before we learn the bond discount and premium, one golden rule we need to know, that we are preparing what? We are preparing the statement of cash flows, and in the statement of cash flows, what do we have? We have the statement of net cash flow from operating activities using the indirect method. Now in the net income, it contains many items that did not involve any cash, but we want cash, so that's why we are removing all the non-cash items. That means all the items from which no cash came in and no cash went out. Okay, now coming over here, what is over here? Bond discount. So now suppose a company buys a bond, the face value of the bond is $100, and the market price, the actual market price is of 95 rupees. It's like buying a t-shirt. It was for $100, but we bought it for 95. So how much is the discount? 5 rupees is the discount. Okay, so what is, and then what is bond premium? Now suppose what happens, the fair value of the bond is 105 and the market price is 100. Similarly, same way, like a t-shirt is in a very much demand, like a sneakers, let's take a sneakers. The sneakers is high in demand, the MRP is 100, but we bought it for 105. No, sorry, I just took it wrong. Wait. Yeah, sorry, yeah, face value is again the 100, market price will be the price at which we will buy, it will be 105. So this 5 is what? This 5 is the premium, because we are paying the extra. Okay, so now what is the term amortization? First of all, discount and premium is clear. This is discount, this is discount, and this is the premium. Okay, so for the amortization, what does amortization means? First of all, I know many of the students are scared of the term amortization. So amortization means, simply it means slowly using up something. So now suppose what happens, this 5 rupees, no, this 5 rupees ka discount or this 5 rupees ka amortization, whatever we have, we are gonna add or reduce the slowly year by year, so that we bring the bond to its actual value of $100. Okay, so that is what the amortization is. Now bond held as investment, that means company is the investor, the company is the investor, and company bought someone else's bonds. Okay, so in that case, company will earn interest income. So think from the investor's angle. So think from the investor angles, what will happen? We will have the discount amortization. So company bought the bond at a discount. That means this scenario, So every year discounted bond gets reduced because interest becomes higher, meaning income increases. So do we have any extra cash coming in? No, only the accounting thing is getting impacted. Therefore income increased because of a non-cash adjustment. Okay, so in the indirect method rule, whenever income increased without cash, in the indirect method, whenever income increased without extra cash, we need to do what? We need to subtract it. Okay, I'll explain it again. What happens in the discount amortization? Company bought the bond at a discount. Now this discount amount will get reduced. Because of this, interest income becomes higher, meaning income is gonna increase. Interest income is increasing, that means what? Our income is increasing. But did any extra cash come in? No, only the accounting is changing. Therefore income increased because of a non-cash adjustment. Now let's take one example. Let's take example over here. Suppose interest income is 100. Out of this, rupees 10 came only because of the discount amortization. Suppose this is another scenario, this is another example. Okay, now so the cash which we actually received is 90 bucks. So my net income is equals to rupees 100 we have recorded, but how much did we cash actually got? Of 90 bucks. So we need to remove this extra 10. Therefore we need to subtract this amount. Okay, so think income became artificially higher. Why? Because this 10 bucks is coming because of the discount amortization. So that's why we need to remove this. Okay, fine. Now coming to the premium amortization. What happens in the premium amortization? Company bought at a premium, company bond bought at a premium, and every year premium reduces. Interest income will become smaller, so income will decrease, but the actually cash is decreasing? No, only the accounting impact is there. So net income is becoming smaller, but to reach the actual cash we need to increase it back. Therefore we are adding it back. Let's take example. Interest received is 100, but premium amortization is this much, income shown is this much. Okay, so net income is this much and cash actually is 100 bucks. So we need to add this 10 rupees. That's why in order to reach this 100, because this was my net income, that's what I recorded, but this was coming as per the premium because of the premium. So that is why we need to add it back. Now bond issued as a debt. This is now the ulta scenario. This is just the opposite scenario. This is the opposite of bond held as investment. Now bond issued as debt, that means company needs money and they are issuing what? Bonds. They are issuing bonds because company needs money, they need money. So now company is not investor, company is itself borrowing the money. That means bondholders will give the company cash. Okay, now company pays the interest expenses. Since they have taken a loan, bond is a kind of a loan, they will pay what? Interest expense. Okay, so everything is opposite now, just opposite of this. Over here discount amortization was subtracted, here discount amortization is added. Why? Because increase in expenses will reduce the income. So if the income is reducing, we need to add it back. Similarly for premium amortization, what will happen? My expenses is gonna reduce, which is gonna increase my income. If my income is getting unnecessarily increased, we need to do what? We need to subtract it. So memory trick, very simple. Expense increased, that means no cash is coming into the picture, we need to add it back. Income increased, no cash is coming into the picture, we need to subtract it. Okay, now coming to the trading securities. So for the trading securities, what is there? For short-term securities bought for quick profit. That means they are bought for quick profit. That means they are held for the usually short terms. They are not for the long term. Okay. They are usually classified as operating activities. So we need to remove gain or loss from the net income. That means subtract gain, add on loss, then include full cash flow in operating section. So sold trading securities for 1 lakh, gain in net income is of 10,000. First of all, we are gonna subtract the gain and add full cash inflow of 1 lakh. So important is point is given, not just the gain, full cash actually is the something that's gonna matter to us. Thank you so much for staying over here with us up till here, guys. If you have any questions, any doubts, please feel free to reach out to us in the comment section, or maybe reach out to me personally. Okay, the remaining 5 slides we are gonna cover in the next set of video. Thank you so much.